10 pitfalls to avoid. Ever heard the phrase, no guts, no glory? Well, when it comes to taking risks, there's one investor who knows how to play the game: billionaire hedge fund manager Bill Ackman. This maverick has a knack for turning a profit and fearlessly embraces risk in his pursuit of success. Meet the mastermind behind Pershing Square Capital Management, Bill Ackman, the founder and CEO of this powerhouse investment firm. With a mind-boggling net worth exceeding $3.4 billion, Ackman ranks among the elite few on Forbes' list of the world's wealthiest individuals. Widely regarded as a titan in the investment world, he has an impressive track record to prove it. Ackman's name is synonymous with a myriad of achievements, including his victorious battles against Wall Street as an activist investor. Additionally, his shrewd moves during the turbulent times of the COVID-19 pandemic have further solidified his position as a savvy operator. However, it is Ackman's audacious gamble against Herbalife, a global multi-level marketing (MLM) corporation specializing in dietary supplements, that truly stands out. Fueled by conviction, he publicly denounced Herbalife as a pyramid scheme, subsequently capitalizing on its downfall through a well-timed short position. These captivating stories associated with Ackman paint a picture of an investor who thrives on an assertive activist investment style, one that has propelled him to remarkable heights. Nonetheless, it is crucial for every investor to exercise caution and remain vigilant against potential pitfalls. In this video, we will explore the 10 most perilous mistakes in investing, as identified by the legendary Bill Ackman. 1. Neglecting to establish a long-term investment plan. We're all familiar with the renown of Bill Ackman and Pershing Square Capital Management when it comes to their short-selling strategy. However, hold on a moment. Ackman has had a change of heart and is altering his approach. He's taken a step back and is now shifting gears to prioritize long-term investments. That's right, ladies and gentlemen, it's time for some tranquility in the investment arena. No more short-term frenzy for this individual. Perhaps he's simply embracing a more serene outlook. Who can say for sure? What we do know is that Ackman's future investments will veer away from the "you only live once" mindset and embrace a calmer, steadier approach where consistent progress prevails. In his annual letter to shareholders published by Ackman, he expressed, "Despite our limited engagement in this investment strategy, it has garnered immense media attention for Pershing Square. Alongside this, copious amounts of media advertisements have been associated with it. Our 2 short activist investments even inspired a book and a movie. Fortunately for all parties involved, and more significantly, for our reputation as supportive and constructive owners, we have permanently retired from that realm." Within the same letter, Ackman introduced Pershing Square 3.0, a new era for his firm focused on long-term investments, a clear indication that Ackman no longer perceives short-term investing as valuable and recognizes that the risks outweigh the rewards. 2. Avoiding overreactions to short-term market swings. If you remain interested in pursuing short-term investments, it's crucial to recognize that Ackman consistently reminds his shareholders and followers about the impact of short-term market fluctuations. During an investor conference held by Bloomberg in New York, Ackman emphasized, "There is a substantial amount of money that moves without considering long-term economic fundamentals." He acknowledged that exchange-traded funds, ETFs, and various leverage strategies have contributed to market volatility, causing it to swiftly fluctuate. Ackman advises investors to exercise caution, urging them to remain vigilant even in the face of the slightest changes that might raise concerns about their investments. However, he also emphasizes the importance of maintaining a comprehensive view of the market before reacting to its shifts. Ackman recommends taking a step back, engaging in thoughtful consideration before making any significant buying or selling decisions, especially when contemplating entering or exiting positions entirely. Though it may sound unexciting, Ackman understands that short-term volatility entails inherent risk, which has led him to evolve into a prudent and wise long-term investor. Before continuing the video, press the like button and subscribe to our channel. Also, don't forget to turn on the notifications to never miss any of our upcoming videos. 3. The importance of fully understanding investment risks. While Bill Ackman is renowned for his appetite for risk, it's important to acknowledge that not all risks lead to success. Nevertheless, calculated risks often yield positive outcomes. One must possess the knowledge of generating risk-adjusted returns before venturing into investments. In Ackman's own words, long-term investments not only mitigate the risks associated with short-term market turbulence, but also significantly increase the probability of profitability. As mentioned earlier, short-term trading exposes individuals to a highly volatile market, necessitating riskier ventures. Ackman argues that developing a well-considered strategy prior to entering the stock market can help minimize behavioral biases induced by short-term market volatility. 4. Placing excessive emphasis on a stock's price rather than its true worth. It's effortless to be swayed by the numerical figures presented in front of us when it comes to our investments, particularly the stock prices. Investors often scrutinize the current stock price and the historical price trends of a specific stock to form conclusions about its potential future performance. However, only a few go the extra mile to assess the intrinsic value of the stock, a more objective measure of its actual worth. This entails identifying stocks that are undervalued, with a price lower than their true underlying value. In an interview with a value investor, Ackman offers guidance, advising investors to acquire high-quality businesses at a price that doesn't accurately reflect the intrinsic value of the business as it stands. He emphasizes that the price should not reflect the potential future intrinsic value resulting from improvements in operations. By doing so, investors can seize a unique advantage, capturing a double discount. This advantage sets them apart from private equity firms, which may purchase a company and optimize its operations to extract additional value, but typically do so at a higher price in competitive bidding scenarios. While investors may not have full control over the company, their proven track record of delivering profits to other investors often grants them sufficient influence to make a significant impact. 5. Recognizing the significance of a company's leadership team. Behind every company's name and logo lies a team of individuals who drive its success, and Bill Ackman shares this perspective. He understands that it is the people working behind the scenes who bring everything together. When making investment decisions, Ackman prioritizes evaluating the management team of a company. After all, a company can only thrive if it has an exceptional group of individuals leading the way. When Ackman aims to revitalize a struggling company, he recognizes that having an outstanding management team is crucial. It's similar to assembling a winning sports team. Having the right players in the right positions is essential for securing the championship trophy. During an interview with Harvard, Ackman emphasized their approach of recruiting top-notch management teams for companies when they have the opportunity to do so. He also highlighted that every company in their portfolio, or where they hold a board position, focuses on being a responsible corporate citizen. It's important to note that a good stock price doesn't always indicate good management, and conversely, a poor stock price doesn't necessarily imply bad management. However, when considering a particular company of interest, it's crucial to assess the track record of its leadership team regarding honesty and legitimate business practices. Paying attention to any individuals embroiled in personal controversies is vital, as it can significantly impact a company's reputation. For instance, looking at examples like Youth Oranos and Elizabeth Holmes, a solid management team is an absolute necessity. 6. Neglecting proper due diligence. Prior to making an investment, when it comes to investing, conducting thorough research on the company you plan to invest in is paramount. In an interview with Bloomberg, Ackman highlights the essential factors that necessitate scrutiny before diving into an investment. Ackman emphasizes the importance of examining the company's management team, their strategic approach, the efficiency of their cost structure, and uncovering any hidden assets. Identifying warning signs or red flags associated with a company is also a crucial step that Ackman advises. These red flags could encompass various aspects such as shifts in the competitive landscape, deviations from industry norms, managerial shakeups, acquisitions, or the emergence of disruptive technologies that reshape the industry. As an investor, it is vital to remain vigilant and stay informed about potential game-changing developments. As a side note, have you ever come across ChatGPT? 7. Allowing emotions to override rational analysis in investment decisions. Maintaining emotional detachment is crucial when it comes to investments. Making decisions based purely on rational analysis, devoid of emotional influence, is paramount. This is a lesson that even Ackman himself should have heeded during the Herbalife controversy he found himself embroiled in a few years ago. In the book, Personal Benchmark: Integrating Behavioral Finance and Investment Management by Daniel Crosby, it is highlighted that while Ackman is an accomplished investor, he allowed his emotions to interfere with his judgment. He became fixated on a personal vendetta, resulting in significant losses amounting to billions of dollars. Instead of adhering to a rules-based approach, the investment turned into a personal battle against someone he held animosity towards. Whenever emotions take precedence over rationality, trouble is bound to follow. Ackman's most significant error was allowing his emotions to cloud his judgment and rational thinking when making investment decisions. 8. Lacking sufficient portfolio diversification. If you are currently viewing this video, you likely possess some understanding of the fundamental principles of investing. You may also be aware that diversification is commonly advised, an approach that involves investing in multiple stocks to mitigate dependence on the performance of a single stock or investment, thereby creating multiple revenue streams. However, it is worth noting that there exists a concept known as over-diversification. During a speech, Ackman voiced his criticism of those who engage in excessive diversification, stating, "I believe many investors over-diversify due to their inclination towards laziness. They fail to conduct thorough research on any of their companies. If they hold 200 positions, do you think they truly comprehend what is happening with each of those companies at this very moment?" Ackman further argues that over-diversification dilutes potential returns, emphasizing the importance of focusing on the best 10 or 11 investments instead of allocating resources to ideas ranked from 12 to 25 or even 12 to 100, as is more commonly seen. While concentration allows for the potential of substantial gains, it may lead to more volatile returns and heightened scrutiny of any mistakes or underperforming aspects. Although portfolio managers often have stocks experiencing declines within their portfolios, the media tends to focus on high-profile situations facing challenges, such as the one currently drawing significant attention to us. Ackman stresses that the ability to concentrate is a highly valuable asset within a strategy, noting that the majority of the top 400 wealthiest individuals in the world amassed their fortunes through one or a select few businesses, as opposed to a portfolio comprising numerous ventures. 9. Overlooking the lessons of previous investment errors. One admirable trait of Ackman is his ability to recognize and learn from his past investment mistakes. Given his aggressive activist short-term investment style, it was almost inevitable for him to make errors. However, unlike others who might downplay or ignore their mistakes, Ackman consistently acknowledges them, apologizes to those affected, and extracts valuable lessons. In his January 2016 annual letter, he dedicated a section to reflect on the mistakes made in 2015, providing insights into the decision-making process at the time. Ackman has openly expressed remorse for his investing mishaps and accepts full responsibility. Nonetheless, he understands that mere acknowledgement and apologies are not enough to become a better investor. Following the losses faced by Pershing Square in 2015, Ackman committed himself to curating a more profitable portfolio. Reflecting on the decline of Valiant, which plummeted by around 70% due to questionable business and accounting practices, Ackman acknowledged that he should have acted on it instead of hoping for a recovery. He acknowledged the need to avoid being restricted and prioritize trading flexibility for better outcomes. 10. Allowing ego to cloud investment decision-making. Even the most accomplished individuals can fall prey to their ego, and Bill Ackman is no exception. As previously mentioned, Ackman's most notable career feat was his short position on Herbalife, but it came at a significant cost. After enduring a grueling 5-year battle, Ackman's determination to bring Herbalife down became entangled with his ego. His nemesis, Carl Icahn, was equally driven to turn the tide in favor of Herbalife, which he ultimately achieved. The clash between Ackman and Icahn escalated into a highly personal feud, with neither willing to back down due to their inflated egos. It took Ackman 5 years to realize that he was playing a losing game, and he paid the price. Who can forget the memorable CNBC debate in 2014, where Icon unabashedly labeled Ackman a crybaby on live television? Ackman eventually recognized that prolonging his ego-driven bet against Herbalife would only result in further losses. While Ackman is revered as a living legend in the investment world, his journey was far from easy, marked by stumbling blocks and setbacks, including the infamous Herbalife saga. Mistakes are an inherent part of the process, and Ackman's example reminds us that even billionaires can err. The key lies in learning from these mistakes and using them as stepping stones on the path to success. By gaining insight into the pitfalls to avoid, aspiring investors can navigate the world of finance more astutely. Don't let mistakes hinder your investment journey. Learn from the best and avoid common pitfalls. Also, press the like button and subscribe to our channel. Don't forget to turn on the notifications to never miss any of our upcoming videos.